Dave took a clean long on Eurodollar. Nice setup, tight stop, everything by the book. 40 seconds later, the candle rips against him, hits his stop, and keeps going 100 pips before it turns back around. No news he could see, no warning, he just got run over. Here's the truth. That candle was never random. Somebody, or a lot of somebodies, pushed it. Today we're opening the hood on this market and meeting everyone who actually drives that price. The central banks, the giant banks, the algorithms, the corporations, the hedge funds, and yes, traders exactly like you. By the end, you'll know exactly who was in that candle that stopped Dave out. Rewind 40 years, and this market didn't have a seat for Dave at all. Trading currencies meant being a bank, a government, or a fund with tens of millions of dollars just to get a quote. Retail traders simply weren't invited. Then online brokers showed up and started splitting those huge interbank trades into tiny pieces anyone could buy. Suddenly, a trader could open an account with a few $100s and place the exact same Eurodollar trade $1 billion fund places. That's the accessibility we take for granted, and it's exactly why Dave's screen shows the same price the big players are trading on. He's not in a separate market. He's in their pool, swimming with much bigger fish. First fish in that pool, the central bank. The Federal Reserve, the European Central Bank, their job isn't to trade for profit, it's to manage the value of their own currency, mainly through interest rates. Watch this. The Fed hikes rates. Higher rates mean money parked in dollars earns more, so capital flows in to grab that yield and the dollar strengthens. Cut rates, or flood the system with new money through quantitative easing, and the opposite happens. The currency gets cheaper because there's more of it chasing the same demand. A single sentence from a central bank chair can move Eurodollar more in 10 minutes than a whole week of retail trading. If Dave's stop was anywhere near a rate decision, this is suspect number 1. Suspect number 2 operates one level below the central bank. The superbanks, names like JPMorgan, Citi, Deutsche Bank. They don't set policy. They run the plumbing. When a corporation needs to convert $1 billion, it calls one of these banks directly. That river of bank-to-bank deals is the interbank market. Decentralized, no single exchange, just banks quoting each other around the clock. These banks act as market makers too. They quote a buy price and a sell price, and the gap between them, the spread, is where they get paid for taking the other side of your trade. When that spread suddenly widens right before a big move, that's banks pulling back liquidity because they smell volatility coming. That widening is a warning, not noise. Suspect 3 isn't even human. Electronic liquidity providers are trading firms that quote prices and fill orders using pure code, no trader on a desk, just algorithms reacting in microseconds. Their edge is speed. High-frequency trading strategies place and cancel thousands of orders a second, scalping fractions of a pip and stitching those fractions into real profit through sheer volume. Here's why that actually helps you. When new information hits the market, these algorithms race each other to reprice instantly, which drags the market price toward what it should actually be. That fast repricing is called price discovery. It also means the tiny, violent spike Dave saw could simply be algorithms sprinting to catch up to a headline half a second before he even read it. Suspect 4 has nothing to do with speculation at all. Picture a U.S. car company that sells vehicles in Germany and gets paid in euros. If the euro weakens before that money gets converted back to dollars, their profit margin shrinks through no fault of their own. So companies hedge. They use Forex contracts to lock in a conversion rate ahead of time and protect a deal they already agreed to, now scale it up. When one company buys another across a border, the buyer often has to convert an enormous pile of one currency into another just to pay for the deal. That single conversion can be large enough to nudge the exchange rate on its own, especially in a quiet session. None of this is speculation. It's business protecting itself, and it still moves your chart. Suspect 5 is closer to home, the speculator. Hedge funds, prop firms, and retail traders like Dave all fall into this bucket, none of them hedging a real business need. They're simply trying to profit from the move itself. That sounds risky, and it is for the trader taking it on, but for the market, it adds lick. Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.